Wealth is not an accident. It's not the exclusive privilege of a chosen few, nor is it reserved only for the lucky or the genetically gifted. Wealth is built by rules, unseen principles that, when followed with discipline and clarity, lead to financial freedom, abundant living, and personal power. This book is not about get-rich-quick schemes, lottery fantasies, or wishful thinking. It's about practical, proven, timeless rules that wealthy individuals across generations have lived by, whether knowingly or unknowingly. These rules are universal. They work whether you're starting with nothing or already on the path to prosperity. Why do some people seem to attract wealth effortlessly while others struggle paycheck to paycheck? The answer lies in how they think, what they believe, and more importantly, the rules they live by. If you want to build wealth that lasts, you must stop operating on emotion and impulse, and start living by principles that govern success. In this audiobook, you will discover the foundational laws of wealth creation. These are the rules that the rich live by, whether in business, investments, relationships, or personal development. If you live by them, you too will become rich, not just in cash, but in freedom, influence, peace of mind, and legacy. The choice is yours, to wander through life financially lost, or to chart your course by the compass of these rules. If you're ready to take responsibility for your wealth and live like the rich do, then let's begin. Welcome to the Rules of Wealth. Written and published by the Zillion Pro. Chapter 1. The Rule of Purpose. Know why you want to be rich. The journey to wealth begins long before you earn your first dollar or make your first investment. It begins in the realm of the mind, with a clear and compelling purpose. Without purpose, money becomes meaningless. Without a why, the how becomes frustrating and, ultimately, unfulfilling. The power of a financial vision. Most people say they want to be rich, but few can articulate why. I want financial freedom is a popular answer, but what does that really mean? Freedom to do what? Travel? Give to charity? Take care of family? Build generational wealth? When your desire for wealth is vague, your actions will be scattered. But when your vision is sharp and vivid, your decisions align with your goals, and your energy becomes focused. That's when wealth begins to form, when purpose fuels your pursuit. Money flows to clarity, confusion repels it. If you chase money just to impress people, fill emotional voids, or escape insecurity, you'll eventually sabotage your own success. But if your wealth is tied to something meaningful, your calling, your legacy, your service to humanity, you'll have the inner fuel to persist through the storms and the patience to build wisely. The law of intentionality. No wealthy person arrived there by accident. Behind every fortune is an intention, a reason, and a mission. Whether it's to disrupt an industry, solve a problem, uplift a community, or build something lasting, intention gives money meaning and direction. This is what I call the law of intentionality. The clearer your financial purpose, the faster and more powerfully wealth will respond to you. The universe rewards clarity. It aligns people, opportunities, and resources with the one who knows what they want and why they want it. Purpose is not just a motivational word, it's a strategic necessity. Finding your personal why. To activate this rule, you must answer this question honestly: why do I want to be rich? Don't settle for surface answers. Dig deep. Here are some prompts to guide you. Who will benefit from your wealth besides you? What impact do you want your wealth to have? What problem in the world would you solve if money wasn't a limitation? What kind of life do you want to live every day? Your answers to these questions become your internal compass. They will help you avoid distractions, withstand setbacks, and stay true to your long-term plan when temporary pleasures or fears try to derail you. Purpose turns discipline into pleasure. It's hard to save money if you don't know what you're saving for. It's hard to work late, invest wisely, or live below your means if you have no higher reason. But when you're purpose-driven, discipline becomes pleasure. Sacrifices feel meaningful. Delayed gratification feels like progress. You'll realize that you're not missing out, you're buying your freedom, your future, and your fulfillment. Purpose is the root of lasting wealth. History is filled with people who made millions and lost it all because they lacked purpose. Wealth gained without purpose becomes self-destructive. You either blow it, lose it, or it becomes a source of anxiety. Purpose grounds you. It keeps you humble in abundance, focused in success, and resilient in hardship. It's the foundation upon which enduring wealth is built. Action steps to apply this rule. 1. Write your wealth purpose statement. Craft a personal statement of why you want to build wealth. Be specific. Example, I want to build wealth so I can retire my parents, fund orphanage projects across Africa, and give my children a better life. 2. Visualize your wealth life daily. Create a mental movie of your wealthy future. See yourself living the life your purpose describes. Feel it. This keeps your goals emotionally alive. 3. Align your actions with your purpose. Before every financial decision, ask, does this move me closer to my purpose or distract me from it? 4. Share your vision with trusted allies. Let a few people in on your why. It creates accountability and invites encouragement when the journey gets tough. Closing thought. The rule of purpose is the first rule for a reason. Without it, the others will eventually fail. Purpose is the magnet that pulls wealth into your life and the anchor that holds it there. You were not born to be average. You were born with a calling. Wealth is simply a tool to fulfill it. So, don't just chase riches, build a reason worth getting rich for. Chapter 2. The Rule of Value. Create more than you consume. If you want to be rich, there is one foundational law you must understand. Money follows value. Not effort, not time, not even need. Value. Those who create more value than they consume rise to the top. Those who consume more than they create remain at the bottom. It's not personal, it's principle. What is value, really? Value is anything that improves someone else's life. It solves a problem. It meets a need. It creates a benefit. It can come in many forms: a product that simplifies someone's life, a service that saves time or generates income, an idea that sparks transformation, a skill that solves a specific problem. Whether you're an entrepreneur, an employee, a freelancer, or an artist, your wealth is directly tied to how much useful value you produce for others. The marketplace rewards problem solvers, not dreamers. The wealth formula: value times scale equals wealth. Let's break that down. 1. Value is the usefulness of what you offer. 2. Scale is how many people you can offer it to. If you solve a $100 problem for 10 people, you've made $1,000. If you solve a $10 problem for 1 million people, you've made $10 million. The more people you serve and the more meaningful your solution, the wealthier you become. Time is limited. Value is not. Trading time for money is the lowest form of value creation. Why? Because your time is limited. You only have 24 hours in a day. That's why you must shift your mindset from trading hours to solving problems, looking for jobs to creating solutions, thinking like a worker to acting like a value builder. This doesn't mean quitting your job tomorrow. It means learning to think in terms of outcomes, not hours. Even as an employee, those who get promoted and paid more are those who solve higher value problems, not those who clock in early and stay late. Are you a producer or a consumer? Let's be honest, most people are addicted to consumption. They consume content, consume entertainment, consume products, but produce very little. And then they wonder why they are broke. Rich people flip that equation. They are net producers. They create more than they consume. They build, they sell, they serve, they solve. Ask yourself this daily: what did I produce today that someone else would pay for? If your answer is nothing, don't expect your wealth to change. Find your value zone. You may be wondering, what value do I have to give? The truth is, everyone has something. Your job is to find the intersection of what you're good at, what people need, what they are willing to pay for. This is your value zone. Once you find it, you must develop it, sharpen it, package it, and then offer it to the world. Examples: if you're good at explaining complex things simply, you can teach, coach, or create content. If you're great with numbers, you can offer financial services or business support. If you're creative, you can design, write, produce, or invent. Your passion becomes profitable when it creates value for others. Don't just work hard, work valuably. People say, work hard and you'll be rich. But that's not entirely true. The world is full of hard-working people who are broke. Wealth is not about working hard, it's about working valuably. A person who digs holes all day works hard. A person who designs software that runs 24/7 while they sleep works valuably. Which one do you think earns more? Don't just aim to hustle. Aim to build something valuable that continues to serve others even when you're not there. The value mindset shift. To live by the rule of value, you must make a mental shift. From entitlement to service. No one owes you anything. Create what people need. From spending to investing. Stop consuming endlessly. Start producing something meaningful. From passivity to creativity. Don't wait for opportunities. Create them through value. Practical steps to apply this rule. 1. Do a personal value audit. Make a list of skills, knowledge, or experiences you have that can help someone else solve a problem. 2. Identify a market need. Research what people are paying for in your niche. Look for pain points or desires you can address. 3. Package your value. Create a product, service, or system based on your skills that delivers results to others. 4. Deliver more than expected. Always give more value than people pay for. That's how you build trust, referrals, and repeat business. 5. Measure your output daily. Ask yourself each day, what did I create today that adds value to the world? Closing thought. The rule of value is the cornerstone of all wealth creation. Until you create something of value, money has no reason to come your way. The more value you bring to others, the more value the world will return to you. Stop chasing money. Start creating value. The money will chase you. Chapter 3. The rule of focus. Master one game before playing another. In a world overloaded with distractions, opportunities, and noise, focus is the new gold. It is one of the rarest and most profitable skills in the modern economy. And if you want to be truly wealthy, not just financially, but in time, peace, and legacy, you must learn to master the rule of focus. Why focus is a superpower. We live in an age where everyone is trying to do everything. Start 5 businesses at once. Learn 10 skills at once. Follow every new trend, hack, or shortcut. The result? Scattered energy, shallow effort, mediocre outcomes. But look closely at every truly wealthy person, every empire builder, every industry leader, and you'll see a different pattern. They mastered one game, one skill, one market, or one vehicle before they diversified. They went deep before they went wide. The myth of the multitasking millionaire. People often idolize billionaires who run multiple companies, like Elon Musk or Richard Branson. But what they miss is that these individuals built one successful foundation first. Musk sold PayPal before launching Tesla and SpaceX. Branson mastered the record business before expanding Virgin into airlines, mobile, and more. They focused first, then multiplied. You don't multiply until you master. Trying to chase too many goals at once is like trying to dig multiple shallow wells. You'll never hit water. The key to wealth is to dig one deep well until the water flows abundantly, then use that to dig others, if you wish. The focus formula for wealth. Laser focus equals leverage. Leverage equals acceleration. Acceleration equals wealth. When you focus your time, energy, and resources on one high-value activity, you gain momentum. That momentum becomes leverage. And leverage is what separates the average from the extraordinary. Whether you're a trader, an artist, a coach, a consultant, or a builder, if you stay in one lane long enough, you begin to dominate it. Your reputation grows. Your skills sharpen. Your income multiplies. But when you spread yourself thin, you stay small. Don't be a dabbler. Be a master. Most people are dabblers. They start something, hit a little resistance, then jump to the next shiny thing. Over time, they accumulate unfinished projects, half-built bridges, and no real results. Wealth does not respond to dabbling. It rewards mastery. Mastery comes from depth, not breadth. It comes from saying no to 99 things so you can say yes to the one thing that really matters. The focus advantage, compounding results. When you focus on one game long enough, something magical happens. Compounding. Just like compound interest grows your money over time, compound focus grows your skill, reputation, and results exponentially. Here's what that looks like. Year 1, you're learning, grinding, and experimenting. Year 2, you start seeing traction and consistency. Year 3 to 5, you gain momentum, systems, and mastery. Year 6 to 10, you dominate your niche, build assets, and become unstoppable. Most people never reach the compounding stage because they quit too early. Focus gets you there. Distraction delays you. How to pick your one game. Choosing what to focus on can be paralyzing. Here's a simple guide. 1. What do you already have skill or experience in? 2. What do people pay for consistently in that space? 3. What activity energizes you and has long-term potential? 4. What market or model has a proven path to wealth creation? Once you identify the game you want to master, commit to it ruthlessly. Block out distractions. Ignore the noise. Put blinders on. Go deep. This doesn't mean you can't pivot or evolve later. It means you don't scatter your power before you've built your platform. Discipline is the companion of focus. Focus requires saying no more than you say yes, no to trends that don't align. No to every business pitch that sounds good but isn't aligned with your path. No to your own impatience. It's not easy, but it's essential. Discipline is not punishment, it's preservation of your vision. Every time you stay focused, you're preserving your time, energy, and momentum. Practical steps to apply this rule. 1. Choose your main game. Decide which business, skill, or market you will give 80 to 90% of your energy to for the next 3 to 5 years. 2. Set a focus window. Create time blocks in your daily or weekly schedule where you only work on your primary goal. 3. Eliminate distraction triggers. Identify your biggest distractions, social media, email, shiny opportunities, and reduce or eliminate them. 4. Track depth, not just breadth. Track progress in your core skill or business. Are you going deeper or just bouncing around? 5. Review weekly. Every week, ask yourself, did I focus on what really matters, or was I distracted by things that don't move the needle? Closing thought. The rule of focus is not about limiting your potential, it's about unleashing it. When you stop trying to be everywhere, you can finally go somewhere. When you stop chasing everything, you can finally catch something that matters. Remember, you only need one game to win big. Master that one. Then build your empire. Chapter 4. The Rule of Leverage. Use systems, people, and tools to multiply your effort. If there is one rule that separates the wealthy from the hardworking but broke, it is this. The rich use leverage. The poor rely only on labor. No matter how talented or hardworking you are, you only have 24 hours in a day, and your physical energy is limited. But leverage gives you multiplicative power. It allows you to achieve 10, 100, or even 1,000 times more without working 1,000 times harder. Wealth creation is not about doing more, it's about doing less with greater impact. And leverage is how that's done. What is leverage? Leverage is using resources beyond your own effort to produce results. It's the principle of using a small input to produce a massive output. There are 4 main types of leverage. 1. People leverage, hiring or partnering with others to expand your capacity. 2. System leverage, creating repeatable processes that run with or without you. 3. Technology leverage, using tools, platforms, or software to automate and amplify. 4. Capital leverage, using money to make more money. The richest people in the world use all 4. The broke use none. You can't do it all alone. One of the greatest lies of the modern hustle culture is this. You have to do it all yourself. Wrong. Self-made millionaires are not self-operated millionaires. They build teams, systems, and tools around their genius so they can stay focused on what matters most. They delegate what they don't need to do. They automate what they don't need to touch. They eliminate what doesn't bring a return. If you insist on doing everything yourself, you will always earn like an employee, even if you call yourself a boss. People leverage, build a winning team. You don't need to know everything, but you need to know people who do. The fastest growing businesses and personal brands are built by those who know how to delegate and empower. Hire people smarter than you in specific areas. Outsource tasks that drain your time. Partner with those who complement your strengths. When you surround yourself with competent people and give them clear outcomes, you multiply your productivity and speed. Remember, if you want to go fast, go alone. If you want to go far, go together. System leverage, build once, benefit forever. Systems are your silent employees. They don't get tired, complain, or need a salary. They just work. Examples: a sales funnel that automatically converts leads into customers. A training system that onboards new hires without your presence. A repeatable marketing process that brings predictable results. Systems create predictability and scalability. Without systems, every result depends on your time and presence. With systems, you can step away without the income stopping. Wealthy people don't just work in the business, they build systems so the business works for them. Technology leverage. Let machines do the heavy lifting. Technology has leveled the playing field. With one smartphone or laptop, you can reach millions of people, sell products globally, automate tasks that once required full-time staff, create content that works for you while you sleep. Don't just use technology to scroll, use it to scale. Examples of tech leverage: email autoresponders, AI writing or design tools, calendar and meeting schedulers, CRM tools to manage client relationships, automation apps like Zapier, Notion, or Trello. The question is not whether you're working hard. It's whether you're using the best tools to get the job done with minimal input. Capital leverage. Make money work for you. This is the highest form of leverage, and the one the wealthy use masterfully. Money is a tool. When you deploy it strategically, it multiplies. Invest in income-producing assets, real estate, stocks, businesses. Use money to buy time by outsourcing and hiring. Reinvest profits into growth. Poor people spend money to feel good. Rich people use money to buy leverage. They don't just work for money, they make money work for them. The leverage mindset. To live by the rule of leverage, you need a mindset shift from doing it all to orchestrating it all. From trading time to building assets. From hustle harder to leverage smarter. You are not paid for how hard you work. You are paid for how well you multiply results. Practical steps to apply this rule. 1. Identify your low-value tasks. List out everything you do daily. Highlight tasks that can be delegated, automated, or eliminated. 2. Hire help early. Even if it's a virtual assistant for a few hours a week, start practicing the muscle of delegation. 3. Build simple systems. Document the steps of your most common processes. Turn them into repeatable workflows. 4. Use technology efficiently. Choose 2-3 tools that can save you hours per week and learn them deeply. 5. Invest in assets. Set aside a portion of your income for investments, whether in education, systems, or scalable income streams. Closing thought. The rich are not rich because they work harder. They are rich because they multiply smarter. They build machines, teams, and systems that work for them so they can focus on vision, strategy, and growth. Leverage is how you go from busy to wealthy, from hustler to builder, from self-employed to financially free. Don't just work harder, work multiplied. Chapter 5. The Rule of Money. Master the game of earning, saving, and growing money. Money is not just currency. It's a game with rules, strategies, and levels. And like any game, those who understand it win, while those who don't, keep losing. Let's explore the rule of money, how to earn more, save wisely, and grow strategically so that wealth becomes your reality, not just your wish. Most people play the money game wrong. They live paycheck to paycheck. They focus only on earning, ignore saving, and never learn growing. They think making money is luck, and growing money is risky. But the wealthy treat money like a skilled chess player approaches the board, with intention, strategy, and control. If you don't control money, it will always control you. Stage 1. Mastering earning. Expand your income power. Wealth begins with earning, but not just any kind of earning. You must learn to increase your income power, how much money you can make through your knowledge, skill, or business. Here's how. 1. Increase your value, not just your hours. You don't get rich by working harder. You get rich by becoming more valuable. Learn high-income skills, sales, copywriting, coding, negotiation, etc. Solve bigger problems in the market. Position yourself as an authority, not a commodity. The market doesn't pay for time, it pays for value. 2. Have multiple streams of income. Don't rely on one job or one client. Build income streams that feed each other. Active income, job, freelancing. Semi-passive income, courses, digital products. Passive income, investments, royalties, real estate. Multiple income streams equals multiple protection layers. Stage 2. Mastering saving. Keep more of what you earn. It's not about how much you make, it's about how much you keep. Many high earners stay broke because they have a leaky bucket. They spend emotionally, live above their means, and never build a buffer. 1. Pay yourself first. Before paying bills or expenses, take a percentage and save /invest it. Set aside 10 to 20% of your income automatically. Treat saving as a non-negotiable expense. 2. Avoid lifestyle inflation. As your income grows, don't let your expenses grow with it. Wealthy people upgrade their investments first, then their lifestyle. Poor people buy liabilities. Rich people buy assets. 3. Track every dollar. You can't manage what you don't measure. Use apps, spreadsheets, or old-school journals. The goal is control. When you control your money, you control your future. Stage 3. Mastering growing. Let your money work for you. This is where wealth multiplies. Saving protects your money. Investing grows it. The wealthy don't just save, they allocate money to grow through smart investments. 1. Invest in yourself. Your mind is your number one asset. Courses, coaching, books, anything that expands your thinking and skill multiplies your income forever. 2. Invest in assets, not appearances. Start with what you understand: real estate, dividend-paying stocks, online businesses, index funds, crowd-funded investments. Even small consistent investments grow massively with time. It's not about timing the market, it's about time in the market. 3. Understand risk and reward. The poor avoid investing out of fear. The rich manage risk by diversifying, doing research, playing the long game. Educated investing is not risky, ignorance is. The wealth equation. Let's simplify the rule of money into a powerful equation. Wealth equals earning minus spending times investment growth multiple by time. Increase earning through value and leverage. Control spending with discipline and strategy. Grow money through long-term intelligent investing. Add time, and let compounding do its work. Even modest actions, done consistently, create financial freedom. Money beliefs that keep you poor. If you grew up hearing money is evil or rich people are greedy, you may unconsciously sabotage your own financial growth. The truth is, money is neutral. It amplifies who you are. Money doesn't corrupt, it reveals character. Wealth is not just for the lucky, it's for the intentional. Change your beliefs, and you change your behavior. Change your behavior, and you change your financial reality. Practical steps to apply this rule. 1. Set income goals. What do you want to earn in the next 12 months? Break it down into monthly targets and skill-based actions. 2. Automate saving. Set up auto debits into a savings or investment account. Out of sight, out of temptation. 3. Cut one wasteful expense. Identify a recurring cost that doesn't add value. Cancel it and reallocate toward investing. 4. Start small investments. Begin with index funds or mutual funds. Even $10 to $50 monthly can build momentum. 5. Track progress monthly. Review income, expenses, and net worth each month. Awareness leads to improvement. Closing thought. Money is not mysterious. It is a game. And like any game, those who learn the rules, play with strategy, and stay disciplined, win. You don't need luck. You don't need a miracle. You need mastery. You need understanding. And once you master the game of money, freedom becomes inevitable. So live by this rule. Earn with skill. Save with discipline. Grow with intelligence. Chapter 6. The rule of investment. Make your money work while you sleep. If you don't find a way to make money while you sleep, you will work until you die. Warren Buffett. Wealth is not built by saving alone. It is built by learning to make your money work harder than you do. This is the essence of investment, the powerful rule that separates the rich from the poor. In this chapter, we uncover the rule of investment, a principle that, when mastered, allows you to create lasting wealth without trading your time for money. Why the rich get richer. The rich understand something most people don't. Wealth is not made by earning alone, but by what you do with what you earn. The average person works for money. The rich let money work for them 24/7, even while they sleep. They don't just hustle, they plant seeds and let time grow them into trees of prosperity. The 3 levels of money activity. 1. Active income. You work for money, job, freelancing, business. 2. Semi-passive income. You work once, get paid repeatedly, books, courses, royalties. 3. Passive income, investments. Your money works for you, dividends, real estate, stock appreciation. To become truly wealthy, you must transition from active to passive income. That's where investment mastery begins. What is investment, really? Investment is the process of committing money to an asset or opportunity with the expectation of future profit or growth. It's about value appreciation over time, not just immediate gratification. Real investors think in years, not weeks. They play the long game, and that's why they win. The mindset of an investor. Before we talk about where to invest, let's talk about how to think like an investor. 1. Delayed gratification. Investors don't chase quick wins, they pursue compounding returns. They understand the power of patience. A tree doesn't bear fruit the same day it is planted. 2. Risk management, not risk avoidance. You don't avoid risk, you manage it through knowledge, diversification, and discipline. 3. Long-term thinking. Every investment should be evaluated not just by the return, but by how it aligns with your financial goals over time. Investment vehicles, where the wealthy put their money. 1. Stocks and equities. Buy ownership in companies. Earn through dividends and capital appreciation. Start with index funds or ETFs if you're a beginner. The S&P 500 has returned an average of 7–10% annually over decades. 2. Real estate. Generates rental income and property appreciation. You can leverage other people's money, mortgages, to acquire assets. Choose stable, cash-flowing properties in growing areas. 3. Business investments. Invest in your own business or someone else's. Higher risk, but potential for exponential growth. Requires due diligence and strong execution. For digital assets, online businesses, domains, YouTube channels, or income-generating websites. Lower overhead, scalable, and global reach. 5. For precious metals and commodities. Gold, silver, and oil can protect against inflation and market volatility. Best used as a hedge, not a primary investment. 6. Crypto and alternative assets. High risk, high reward. Requires education and extreme discipline. Only invest what you can afford to lose and diversify accordingly. The power of compound interest. Albert Einstein called compound interest the eighth wonder of the world. Here's why: it grows your money exponentially over time. Example: invest $500 per month at 10% annual return. In 20 years, you don't just have $120,000, you have over $330,000. The earlier you start investing, the less you have to invest to build wealth. Common mistakes to avoid. 1. Waiting too long to start. Time is your greatest ally in investing. Start small, but start now. 2. Chasing trends without understanding. Never invest in something you don't understand. Study first. 3. Putting all your eggs in one basket. Diversify across industries, asset types, and risk levels. 4. Emotional investing. Fear and greed cause bad decisions. Follow a strategy, not your emotions. Your investment blueprint, a 5-step strategy. 1. Educate yourself. Read books like The Intelligent Investor and Rich Dad Poor Dad. Follow trusted sources. Never invest blindly. 2. Set clear investment goals. Know what you're investing for: retirement, freedom, a house. This shapes your risk profile and time horizon. 3. Budget for investment. Allocate a fixed percentage of your income for investing, for example, 10 to 30%. 4. Start with what you know and grow. Begin with familiar assets, then expand as your knowledge increases. 5. Review and adjust periodically. Monitor your portfolio, reallocate as needed, and stay informed. Real wealth is built in silence. You don't need to flaunt it. The wealthiest investors are often quiet accumulators, disciplined, strategic, and focused on the long game. The loudest people are usually not the richest. The wealthiest are often invisible. Closing thought. The rule of investment is simple, but powerful. Make your money work harder than you do. Don't trade your life for every dollar. Use each dollar you earn as a soldier. Send it out into the world to bring back more. Start small. Stay consistent. Be patient. And in time, the investments you plant today will become the financial freedom you live tomorrow. Chapter 7. The rule of discipline: live below your means, invest the rest. Discipline is the bridge between goals and accomplishment. Jim Rohn: at the heart of every wealthy individual lies a principle most people avoid: financial discipline. You can earn a lot and still be broke. You can have a modest income and become rich. The difference is not how much you make, it's how you manage what you make. This is the rule of discipline. Live below your means, invest the rest. It's a simple rule, but it demands strength of character, self-control, and vision. The illusion of wealth versus the reality of wealth. We live in a world that equates wealth with appearance. A new car, a big house, designer clothes, exotic vacations. But most of what people call wealth is debt-driven consumption, not real assets. True wealth is invisible. It's savings, investments, assets, not liabilities disguised as lifestyle. Many look rich but are drowning in debt. Few look ordinary but are sitting on a mountain of quiet fortune. What living below your means really means. It doesn't mean being cheap. It doesn't mean living like a monk. It means spending with wisdom, not impulse. It means having the self-discipline to say, I don't need this now. I'll save and invest first. I choose long-term freedom over short-term pleasure. Living below your means is intentional living, deciding where your money goes instead of wondering where it went. The psychology of financial discipline. Why do people struggle to live below their means? Because we are wired for instant gratification. Because we chase social validation over personal vision. But to become wealthy, you must train your mind to love delayed gratification more than fleeting pleasure. Discipline begins in the mind. Wealth begins in the habits. The 50-30-20 budget rule, or better. A useful structure to start with: 50% needs, housing, food, bills. 30% wants, dining out, hobbies, entertainment. 20% savings and investments. But if you truly want to build wealth fast, flip the script, live on 50% or less. Invest 30 to 40%. Save 10 to 20% for emergency and opportunities. If you can live on less, you can invest more, and the more you invest, the faster you grow. How the wealthy practice discipline. 1. They have a budget and stick to it. They know where every dollar goes. They don't overspend because they track, adjust, and control their spending. 2. They avoid lifestyle inflation. When their income increases, their spending doesn't follow. Instead, they raise their savings and investment contributions. 3. They delay gratification. They drive older cars longer. They upgrade only when it aligns with their financial goals, not emotional whims. 4. They automate wealth creation. They automate savings, investments, and contributions to retirement accounts so they don't rely on willpower alone. Discipline is the ultimate financial leverage. Think of every dollar you don't spend as another brick in your wealth wall. That $5 coffee daily, $150/month, $1,800 per year. That new iPhone, $1,000 today, or $5,000 in lost investment returns over 10 years. Small leaks sink big ships. Plug your leaks. Build your boat. The power of frugality with purpose. Frugality isn't deprivation. Frugality is control. It's choosing to own your future rather than rent your lifestyle. You can say no to short-term temptations because you've said yes to long-term wealth. You stop competing with people who aren't building anything. You start making your money obey your vision, not your emotion. Discipline protects you in bad times. When the economy crashes, those who live below their means survive and thrive. They have emergency funds. They have investments. They can take advantage of opportunities while others panic. Financial discipline is your financial armor. It guards your wealth, extends your freedom, and preserves your peace of mind. A wealth discipline action plan. 1. Track every expense. For 30 days, write down everything you spend. You'll be shocked at the unconscious spending you can eliminate. 2. Set spending limits and stick to them. Create monthly caps for eating out, shopping, and entertainment. 3. Automate investments. Set up automatic transfers to your investment accounts before you spend a dime. 4. Cut one unnecessary expense each month. Redirect that money into your wealth building account. 5. Review monthly, adjust quarterly. Discipline is a lifestyle, so revisit and refine your financial strategy often. Closing thought: the real reward of discipline. Discipline is freedom. It gives you freedom from debt, freedom from paycheck dependency, freedom to retire early, freedom to travel, give, and enjoy life on your terms. Living below your means is not a limitation, it's a liberation. Choose to invest in your future rather than indulge every fleeting desire. You don't have to be perfect, you just have to be consistent. Start today. Live below your means, invest the rest, and watch wealth become your way of life. Chapter 8. The Rule of Risk. Take calculated risks, avoid foolish gambles. The biggest risk is not taking any risk. Mark Zuckerberg. There is no wealth without risk. Every wealthy individual, every self-made millionaire, got there not by playing it safe all the time, but by taking calculated risks. At the same time, the truly wealthy avoid one thing with precision: foolish gambles. This chapter is about understanding the difference between the two. What is a calculated risk? A calculated risk is not a blind leap, it's a well-measured step. It's when you evaluate the upside, the downside, the probabilities, and then decide to move forward with clarity and conviction. Examples: investing in stocks after thorough research, starting a business with a clear plan and market analysis, buying real estate in a developing neighborhood after trend evaluation. A calculated risk is a risk you can live with if things go wrong, and benefit massively if they go right. What is a foolish gamble? A foolish gamble is when you act on emotion, hope, or hearsay, without strategy or safety net. Examples: betting your life savings on a friend's sure deal, investing in crypto just because it's trending, quitting your job with no plan, no savings, no skills. A gamble is blind faith. A calculated risk is informed action. Why risk is necessary? There is no growth without risk. Staying in your comfort zone leads to mediocrity. Taking smart risks leads to new income streams, wealth expansion, and generational impact. The difference between the rich and the average is often this: the rich risk wisely, the average avoid risk or leap blindly. Wealth building requires you to leave the shore, but you don't set sail without checking the weather, preparing the ship, and knowing your destination. The risk-to-reward ratio. Smart investors and entrepreneurs always ask, is the reward worth the risk? They analyze, what's the worst-case scenario? Can I handle the loss if things go wrong? What's the potential gain if things go right? What's the probability of each outcome? If the upside is significantly greater than the downside, and manageable if lost, it's worth taking. This mindset doesn't eliminate fear, but it manages fear with logic and foresight. How to take calculated risks. 1. Educate yourself first. Never risk money or time on something you don't understand. If it's stocks, learn the basics. If it's a business, study the market. Knowledge reduces risk and increases reward. 2. Start small. Don't bet the farm on your first move. Test small. Measure results. Scale later. 3. Diversify your risk. Don't put all your capital in one investment. Have multiple streams, so one loss doesn't wipe you out. 4. Have an exit strategy. Know when to pull out, when to pivot, and when to pause. 5. Use data, not emotion. Don't invest because it feels good. Do it because the numbers make sense. Examples of smart risk-taking. Elon Musk risking his last millions on SpaceX and Tesla, but only after deep research, clear vision, and technical strategy. Real estate moguls investing in distressed properties during a downturn because they understood the recovery cycle. Entrepreneurs quitting their 9-to-5 only after building a sustainable side income for 6 to 12 months. They didn't jump blindly. They calculated, prepared, and then acted boldly. How to avoid foolish gambles. 1. Avoid FOMO, fear of missing out. If everyone's jumping in, it's often already too late. Wealth is created before the crowd arrives. 2. Don't act on hype or emotion. If your reason for investing is everyone is doing it, you're not making a decision, you're gambling. 3. Never risk more than you can afford to lose. Only risk what won't destroy your financial future. 4. Don't confuse luck with strategy. Someone who got lucky in crypto or trading is not a model. Luck is not a replicable strategy. Failure is part of risk. Even calculated risks don't always work out, but failure doesn't make you a fool as long as the risk was strategic. Learn from it, adjust your approach, try again. Every wealthy person has stories of failure. What they don't have are excuses for not trying. Fear will always be there, act anyway. The goal is not to eliminate fear but to manage it. Courage is moving forward despite the fear because the vision is greater than the obstacle. Wealthy people feel the fear and do it wisely anyway. Questions to ask before taking a risk. What do I know about this? What's the worst case scenario, and can I handle it? What's my backup plan? Have I done enough research? What's the potential return if it works? Closing thought. Risk is the price tag of greatness. To live without risk is to live without growth. To take risks without calculation is to invite destruction. Your job is not to eliminate risk, but to master it. Educate yourself. Plan for the worst. Expect the best. Take action when the numbers and logic align. Calculated risk is how fortunes are built. Foolish gambles are how fortunes are lost. Take the leap, but measure the height first. And always pack a parachute. Chapter 9. The Rule of Network. Your net worth is in your network. Your network is your net worth. Porter-Gale. Money, assets, and investments matter, but they are not everything. In the world of wealth, who you know is often as important as what you know or own. This chapter is about the power of your network, why your connections can open doors that money alone cannot, and how building the right relationships accelerates your path to wealth. Why network matters more than ever. In today's interconnected world, opportunities often flow through relationships. The right connection can mean a business partnership that multiplies your income, access to insider knowledge before the market shifts, mentorship from those who have already succeeded, referrals that bring high-value clients or deals. Wealth is rarely built in isolation. The richest people have vast networks of trusted advisors, collaborators, and supporters. The difference between contacts and networks. A contact is a name in your phone or LinkedIn. A network is a web of meaningful relationships, built on trust, mutual benefit, and respect. Your network includes mentors who guide you, peers who challenge and support you, mentees who inspire you to teach and grow, industry insiders who provide valuable information. How networks create wealth. 1. Access to opportunities. Often, the best deals and jobs aren't advertised, they are shared within networks. 2. Shared resources and knowledge. Networks provide insights and knowledge you might never find alone. They help you avoid mistakes and capitalize on trends. 3. Collaboration and partnerships. Your network can become your business partners, investors, or clients. 4. Emotional and psychological support. Wealth building is challenging. A strong network helps you stay motivated and accountable. Building a wealth-building network. 1. Be intentional. Don't just meet people randomly. Attend industry events, seminars, workshops, and mastermind groups aligned with your goals. 2. Provide value first. The most powerful networks are based on reciprocity. Ask yourself, what value can I offer before I ask for help? Offer your skills, knowledge, or connections. 3. Be genuine. Authenticity builds trust. People can sense when you are sincere or just trying to extract value. 4. Stay consistent. Relationships deepen over time with regular contact. Follow up, check in, celebrate others' successes. Networking mistakes to avoid. Being transactional, only reaching out when you need something. Spreading too thin, trying to connect with everyone but never building depth. Ignoring diversity, limiting your network to people just like you. Neglecting online presence. In the digital age, your online network matters as much as face-to-face. Leveraging online networks. Platforms like LinkedIn, Twitter, and industry forums can supercharge your network. Key tips: optimize your profiles professionally. Share valuable content regularly. Engage thoughtfully with others' posts. Join relevant groups and participate actively. The power of mentorship. Having mentors is a shortcut to wealth. Mentors provide wisdom, accountability, and sometimes financial support. But mentorship is a two-way street. Be teachable, respectful, and show gratitude. Networking for different wealth goals. Entrepreneurs connect with investors, suppliers, and customers. Investors build relationships with financial advisors, analysts, and fellow investors. Employees and career builders network with mentors, industry leaders, and peers. Networking is a long-term game. You won't become wealthy overnight through your network. It takes time to build trust, exchange value, and grow mutually beneficial relationships. Think of networking as planting seeds that grow into fruitful trees over years. Your network reflects you. The quality of your network mirrors your own value. Invest in yourself, your knowledge, skills, and character, and your network will grow in quality. Surround yourself with people who challenge and elevate you, not those who drain your energy or hold you back. Practical steps to expand your network. 1. Attend at least one networking event per month. 2. Schedule regular catch-ups with key contacts. 3. Join a mastermind or business group. 4. Offer to introduce 2 people in your network who could benefit from knowing each other. 5. Engage with content and groups on professional social media platforms weekly. Closing thought. Network is wealth multiplied. Money is limited. A strong network is limitless. Every new relationship can be a doorway to new wealth, new ideas, and new horizons. Invest time and energy in building your network as seriously as you invest money. Your net worth depends on it. Chapter 10. The rule of adaptability: evolve or become obsolete. It is not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change. Charles Darwin. In the journey to wealth, adaptability is survival. The world is constantly shifting, economies fluctuate, industries transform, technology advances, and consumer behaviors evolve. Those who cling rigidly to old ways or refuse to change quickly become irrelevant. This chapter reveals why adaptability is one of the most critical rules of wealth and how mastering it will keep you ahead in the race for lasting success. Why adaptability is essential in wealth building. The pace of change today is faster than ever before. Consider these examples. Blockbuster, once a giant in video rental, failed to adapt to digital streaming and was wiped out by Netflix. Kodak, a pioneer in photography, ignored digital technology and lost relevance. Businesses that embrace digital marketing, e-commerce, and remote work thrived during the COVID-19 pandemic while others struggled. In wealth building, what worked yesterday may not work tomorrow. The ability to pivot, learn, and evolve separates winners from those left behind. The cost of resistance. Resistance to change leads to missed opportunities, declining income, increased stress and frustration, eventual obsolescence. If you don't evolve your skills, investments, or business models, you risk becoming irrelevant. Wealth is not just about accumulation, it's about sustainability. How to cultivate adaptability. 1. Embrace a growth mindset. View challenges as opportunities to learn, not threats. Be curious, ask questions, and seek new knowledge. 2. Stay informed. Keep up with trends in your industry and the global economy. Read books, listen to podcasts, attend seminars. 3. Be willing to pivot. If an investment isn't performing or a business strategy fails, be ready to change course quickly. 4. Learn new skills. The more versatile your skills, the more adaptable you are. Invest in continuous education, whether formal courses or self-study. Adaptability in investing. Markets evolve, and so should your portfolio. Diversify into emerging sectors like technology, renewable energy, or healthcare. Adjust asset allocation based on economic cycles. Use new tools like robo-advisors or AI analytics. Adaptability in business. Businesses that survive decades have a history of reinvention. Apple shifted from computers to music players to smartphones. Amazon evolved from an online bookstore to a global e-commerce and cloud computing giant. Ask yourself, is my business model still relevant? Am I meeting my customers' current needs? Overcoming fear of change. Fear is the biggest barrier to adaptability. Fear of failure, fear of the unknown, fear of losing what's comfortable. How to overcome it? Focus on potential gains, not just risks. Break change into small, manageable steps. Surround yourself with adaptable people who inspire you. Practice resilience. Remind yourself that setbacks are part of growth. Adaptability and personal growth. Wealth isn't just financial, it's also about mental and emotional richness. Being adaptable means accepting feedback and criticism, letting go of limiting beliefs, Cultivating emotional intelligence. Being open to new experiences. The role of technology. Technology is one of the biggest drivers of change. Adaptability means embracing technology, not fearing it. Automate repetitive tasks. Use social media to grow your brand. Learn digital marketing and e-commerce. Stay ahead of AI and machine learning trends. Practical steps to become more adaptable. 1. Schedule regular self-assessments to review what's working and what's not. 2. Set learning goals each quarter. Read a new book, take a course, or learn a new skill. 3. Seek feedback from mentors, peers, and customers. 4. Experiment with new ideas on a small scale before full implementation. 5. Build a diverse network. People from different industries, cultures, and experiences stimulate adaptability. Closing thought. The future belongs to the flexible, the curious, and the resilient. Wealth is not just a destination but a journey that requires constant evolution. When you commit to adaptability, you don't just survive change, you thrive in it. Embrace change. Learn fast. Pivot boldly, because in the game of wealth, those who evolve are the ones who win. Chapter 11. The Rule of Generosity. Give and you shall receive. We make a living by what we get, but we make a life by what we give. Winston Churchill. Generosity is often misunderstood as a weakness or a sacrifice when it comes to wealth. Yet, true wealth is deeply intertwined with the power of giving. The most successful and fulfilled people understand that generosity creates a powerful cycle of abundance. This chapter explores why giving is a core rule of wealth and how it transforms your life, your relationships, and your financial success. Why generosity matters in wealth building. At first glance, giving away your resources may seem counterintuitive to getting rich. However, generosity builds trust and goodwill. It expands your network by attracting like-minded people. It creates positive karma or mutual compensation. It enhances your reputation and personal brand. It opens doors to unexpected opportunities and partnerships. Generosity is not just charity, it is a strategic investment in human relationships that yield long-term dividends. The law of mutual compensation. This principle states, for every act of genuine generosity, there is an innate psychological urge in others to reciprocate. When you help others without expecting immediate returns, you build a bank of goodwill that pays off in unexpected ways, whether through referrals, support during tough times, or new business. Different forms of generosity. Generosity isn't only about money. It includes time, mentoring, coaching, or simply listening. Knowledge, sharing insights, teaching, or creating helpful content. Resources, providing tools, connections, or opportunities. Kindness, offering encouragement, support, or respect. Why generosity feels good. Scientific studies show that giving activates the brain's reward system, releasing dopamine, the feel-good neurotransmitter. This helps high reduces stress and increases happiness. Generosity nurtures your soul and builds emotional wealth, which is just as important as financial wealth. How generosity builds wealth. 1. Attracting abundance. When you give, you signal abundance, not scarcity. People want to do business and partner with those who have a mindset of plenty. 2. Building strong relationships. Generous people foster deep loyalty and trust, foundations of strong personal and business networks. 3. Creating a legacy. Giving builds a legacy that outlasts money, impacting lives and communities. Practical ways to practice generosity. Give before you get. In business, provide value upfront without demanding payment immediately. Mentor someone. Share your knowledge with those starting out. Support causes. Invest time or money in charities or community projects. Celebrate others' success. Give genuine compliments and recognition. Pay it forward. When someone helps you, find a way to help another person. Common misconceptions about generosity. It will make me poorer. On the contrary, generosity creates a cycle of return. Only the wealthy can give. Everyone has something to give: time, advice, kindness. I must expect something in return. True generosity is unconditional. Returns come naturally. It's a sign of weakness. Generosity requires courage and confidence. The power of strategic generosity. Strategic generosity means giving with intention and wisdom. This could mean supporting causes aligned with your values. investing in relationships that matter most, sharing knowledge in ways that build your authority, overcoming barriers to generosity, fear of scarcity. Remind yourself wealth is not zero-sum. Lack of time, even a few minutes mentoring can be impactful. Uncertainty, start small and increase generosity as you grow. Closing thought. Generosity is a secret multiplier in the wealth equation. It elevates you beyond mere accumulation of money to become a person of influence, purpose, and lasting impact. Give without hesitation. Give with joy, because in giving, you unlock the true riches of life. Chapter 12. The Rule of Patience. Wealth is built, not wished. Patience is not simply the ability to wait, it's how we behave while we're waiting. Joyce Meyer. In a world obsessed with instant gratification, patience often feels like a forgotten virtue. Yet, when it comes to building wealth, patience is one of the most powerful assets you can possess. Wealth is rarely created overnight, it is the result of consistent, disciplined effort sustained over time. This chapter examines why patience is a fundamental rule of wealth, how impatience sabotages financial success, and practical ways to cultivate patience on your wealth journey. The reality of wealth creation. Many people desire wealth, but few are willing to endure the journey it takes to get there. Movies and social media often glamorize quick riches, but the truth is, real wealth is built gradually through steady saving, investing, and smart decision-making. Businesses grow over years of trial, error, and adaptation. Investments compound over decades. Skills and expertise take time to develop. Trying to rush wealth often leads to poor decisions, reckless risk-taking, and burnout. The danger of impatience. Impatience manifests as chasing get-rich-quick schemes, constantly switching investments or business strategies without giving them time to mature. Overspending or failing to save because of a desire for immediate enjoyment, frustration and giving up too early on promising opportunities. This impatience not only stalls wealth but can also cause significant financial losses. The power of compound growth. One of the clearest examples of patience in wealth building is the power of compound interest. Money invested grows exponentially when interest is earned on both the initial principal and the accumulated interest. The longer you leave your money invested, the greater the growth. Legendary investors like Warren Buffett emphasize patience as a key to their success. Patience allows compound growth to work its magic. Patience in entrepreneurship. Building a business demands endurance. Profits may be low or non-existent in the first years. Learning from failures takes time. Establishing trust and reputation is a gradual process. Successful entrepreneurs focus on long-term vision instead of short-term gains. Cultivating patience. Practical strategies. 1. Set realistic expectations. Understand that wealth takes time. Avoid comparing your progress with others. 2. Break goals into milestones. Celebrate small wins along the way to stay motivated. 3. Practice mindfulness and stress management. Patience grows when you manage emotions and stay calm under pressure. 4. Focus on process, not just outcome. Enjoy the daily habits that build wealth, budgeting, learning, networking. 5. Build discipline through routine. Consistent saving and investing require discipline, which is nurtured through routine. Patience and emotional intelligence. Patience is closely linked to emotional intelligence. It helps you manage impulses, enables thoughtful decision-making, reduces stress and anxiety related to financial goals. Mastering patience improves your overall financial mindset. J.K. Rowling faced years of rejection before Harry Potter became a global phenomenon. When to act and when to wait. Patience doesn't mean passivity. It means knowing when to act decisively and when to give things time to develop. Avoid impulsive decisions driven by fear or greed. Evaluate opportunities carefully. Take consistent action but resist the urge to micromanage or force outcomes. Overcoming the urge for instant results. We live in an age of immediacy. To cultivate patience, limit distractions like excessive social media. Practice gratitude for what you have. Visualize your long-term goals regularly. Closing thought. Patience transforms the way you approach money and success. It teaches you to trust the process and persist through challenges. Remember, the richest people aren't those who got lucky, they are those who showed up, day after day, year after year, building their wealth brick by brick. Wealth is built, not wished. Embrace patience and watch your fortune grow steadily and surely. Final reflection. Wealth is not a secret, nor is it reserved for a select few. It is the natural result of following proven principles with consistency, discipline, and faith in the process. The rules you've learned in this book are not just theories, they are timeless truths that have shaped the lives of the world's most successful individuals. If you commit to living by these rules, wealth will no longer be a distant dream, it will become your reality. Stay focused, stay patient, keep growing, live by the rules, and you will live rich.